I think the economy is worse than is being represented, and especially when broadcast in the mainstream media. And I think inflation is running much higher than is being represented, and I think the stock market is just an accident waiting to happen, and it's going to be a bad one.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up, and we're fortunate to have with us Dave Kranzler. Dave is a hedge fund manager, precious metals analyst, and author of a biweekly subscription newsletter, the Mining Stock Journal. After years of trading expertise built up on Wall Street, Dave now co-manages a Denver-based precious metals and mining stock investment fund, and he strives to help people understand the truth of our financial system and our economy. Dave, thank you so much for joining us today.
Gary, thanks for having me on. It's a pleasure.
So let's begin with a look back on this past year. From an economic and market perspective, what surprised and shocked you? What fell right in line with expectations? And what are you expecting moving into 2025?
Ooh, there's a lot to unpack there. I'm kind of surprised that there's still, it's a lot of it's just in the mainstream media. The narrative is out there that, inflation is coming down, which it's not if you used a real inflation measurement gauge or index. And also that the economy is doing well. And I also publish a weekly short sellers journal. It's obviously, it is what the title says it is. But as part of that, I study all the economic data that I can get my hands on during the course of a week. And from what I can see, and it's more so in the privately released, private sector of the economy released economic reports and the regional Federal Reserve Bank manufacturing surveys. If you study those, they're basically telling a completely different story than what we get from the government released data, which most of it is extremely massaged for political expedience purposes. And the manufacturing sector has been in a recession for the better part of 2 years. And if you break down those reports, and there's some other ones, some of the PMI reports that come out, and you look at the sub indices. I mean, they've been talking about, or they've been showing that input prices have been rising since this summer. And so this slight uptick in inflation that's being reflected in the CPI, I mean, I predicted that we were going to, inflation was going to come back pretty strong. I thought it would happen at the start of 2025, but it's starting to show up even in the CPI reports for the last two months. So I guess in terms of surprise, I can't believe that you turn on CNBC or something, or you listen to the Fed and they say the economy is doing fine, which it's not. In terms of, I guess I was kind of surprised. I was at first until I figured out what was going on. I was kind of surprised by the absolute melt up in the stock market. Now, obviously, part of that is euphoria over rate cuts, but the rate cuts really don't have anything to do with it. If you look at what's going on, so that reverse repo facility that grew to 2.3 trillion at its peak. I think year-end 2022, it might have popped up to 2.5, but it always jumps at the end of the year. The last few days of the year. But so it grew to 2.3 trillion, and the Fed started letting it drain around March 2023. I'm just speaking from memory. Look, there's a chart on the website that you can look and you can see where it starts going down. And the reason why I say it let it drain, so what I think a lot of people overlook is the money that piled into that, the 2.3 trillion that piled into that facility, that was part of the 4 trillion that the Fed printed in 2020. And so the Fed needed, I think a lot of that money had nowhere to go because, the economy is going downhill. There's no really meaningful private sector investments where that money can flow into. A lot of it was in money market funds. And so the Fed was able to trap it and get it out of the financial system because it knew it was going to create an even bigger inflation problem by raising the rate that it pays on the overnight repos to slightly above T-bill rates. And so, but then it started, and I don't think it's coincidental that the Fed started letting it drain around the time that we had the regional bank blow up. And so now, and I just checked before we got, started recording, that thing's down to 98 billion. And a lot of that money has been used to finance the T-bill issuance that the government's been doing. And then what happens is, and the rest of it ends up on bank balance sheets, it boosts their reserves, and then they can hand out reckless loans to hedge funds and other private pools of capital that then pile into the stock market. And then the money that the government takes in and spends, that also winds its way back into the system. And so I'm convinced that's really the base cause of the stock market melt up that we've had. I mean, this bubble, I don't know if you were involved in the markets back in the late 90s, but this bubble is way bigger and is going to be far more damaging when it pops than the dot-com bubble was. So and that money is also that's been drained from there. That's also why inflation is running hotter than the Fed would like it to. And, again, as I alluded to earlier, if you used a real bona fide inflation measurement index, it would show inflation running at least twice what the CPI is showing.
There's a lot there to chew on. So Dave, let's look back a couple of days here. After Fed Chair Powell announced that they were cutting 25 basis points the other day, the Dow dropped $1,100. The S&P dropped 180. The Nasdaq dropped 715. Gold dropped 50. Bitcoin dropped 5,400, and the 10-year yield rose to over 4.5%. There was a lot going on there. The VIX spiked. Why did all of that happen?
I mean, the FOMC policy statement and then the press conference, the Powell's remarks at the press conference took the bubble heads by surprise. And it was interpreted as the Fed becoming either less dovish or more hawkish, which, that's another thing that irritates me is when mainstream analysts reference the Fed as having a hawkish monetary policy. It's not a hawkish monetary policy. The real inflation rates, again, using a real inflation barometer, are still negative, even at 4.5% on the 10-year. But at any rate, the Fed essentially implied that it was not going to cut rates as many times as I think was priced into the stock market in 2025, and it indicated that it's probably not. It has to be done for this year, but the rate cuts may not come until later in 2025. And so you had a lot, that sell-off that we had, and it's somewhat reversed today. Yeah. There was a lot of really hot money that had just piled into the market over the last, I guess, since probably call it the end of October. And a lot of that just, I think a lot of it was sort of hedge funds and their algorithmic computers reacting to what the Fed's statement and Powell's remarks. And I think that's what caused the sell-off. But by many measures, most, if not all, this is by far the most overvalued stock market in history. So,
by many measures. Yeah.
And I think what happened after, the Fed did what it did and said what it said, I think that's kind of a warning signal about, what could happen in 2025 to the market. What's interesting to me is that you referenced the 10-year yield. I mean, the 10-year is up roughly 100 basis points since the Fed started cutting.
Yes.
And there, the commentators are, especially if you look at Zero Hedge calls it, evidence that the Fed's committing policy error here. And I don't think that's the case. I mean, we can get into it if you want. I don't think the Fed is cutting rates to try and stimulate the economy. I think there's more profound issues going on that it's trying to address with lower rates. So, to me, the reason why the long end of the curve is steepening and is blowing out is because at some point I think you got the bond market is anticipating higher inflation rates and possibly eventually more QE. So
I've got a couple of questions coming up on these. I want to ask you one more question on Powell, though. In his press conference, he stated, we have core inflation coming down to 2.5% next year. That would be significant progress. That's what he said. So after a year of the transitory narrative, followed by the fastest rate-raising campaign in recent history, then they saw enough in the data to lower rates, like you said, by 100 basis points. And yet after all of that, they still haven't been able to get inflation down to the base rate of 2%, and they don't even foresee that happening next year either. 2.5% is what he sees next year. So Powell signaled that this was really interesting to me. He signaled that the Fed's focus has returned firmly to inflation. So here they are focusing on inflation for the last 3-4 years. He has to keep reiterating that he's firmly focused on it, yet he can't bring it down to 2%. Why haven't they been able to bring inflation down to this mythical 2% number or lower? And is 2% anytime soon, is that a pipe dream?
Well, first of all, I think it's Orwell speak. It's Orwellian to say that inflation is at 2.5% because it's not. And the core rate, well, let's just throw everything out of the index that people have to spend money on every day. But even those things are going up at a faster rate than 2.5%. And to be honest, the Fed knows this. The Fed has the most sophisticated and largest research department of any entity in the world. So they know that inflation is a lot higher than what the CPI is saying. I mean, are you familiar with John Williams and his shadow government? Okay, yeah. So he recalculates, and he openly lets it out there freely on his website. He openly calculates he redoes the CPI the way that it was calculated in 1990 and in 1980. Now, 1980 is significant because that's about the time that the Fed started dickering or the government started dickering with massaging inflation lower, because it knew that once we went off the gold standard, they were going to start printing money and the government was going to issue a lot more debt, and that was going to be inflationary. So I can't take him seriously when he stands up in front of us and tries to tell us that the core rate's down at 2.5%. Now, again, the reason why they can't get the inflation rate down is twofold. One, I mean, the Fed puts all this focus, and the mainstream media, financial media, puts all this focus on what the Fed's doing with interest rates. Well, that's the magician's distraction. If you look at what's happening with the money supply, M2 has been going up since October 2023, and there's some other measures. The monetary base, which is the most powerful form of money supply, that started rising back in March of 2023. So, and who knows what M3 would be if they would start publishing it again. If you recall, Bernanke Bernanke's Fed stopped publishing that, I believe, in October 2006. They said it was too expensive. I mean, they can spend millions fighting an audit the Fed bill by Ron Paul, but they can't spend a little bit of money to show us what the real money supply is, or the truest measure of the money supply.
Yeah.
So that's the reason why inflation is not going to come down. I mean, it's like Milton Friedman said: inflation everywhere and always is a monetary phenomenon. And you've got the supply of fiat currency, an increasing supply of fiat currency units chasing what is really a decline in wealth output on a real basis when you adjust the GDP with a real inflation number. So, and that's, it's a simple supply and demand, right? More money chasing less relative amount of goods and services, and you're going to drive the price up. And the draining of the reverse repo fund is a big part of that.
So I have a question on M2 coming up, and not quite yet. Dave, as stocks have hit all-time highs, corporate insiders and executives, they've been cashing out of their stocks at record levels. In fact, there's 6 times more insider sellers than buyers. This is basically a historic number. Why are insiders cashing out of the strongest market in history? What is actually happening here?
Well, I mean, they're insiders and they see the inside books. I mean, the GAAP financials that most companies present, especially companies like Tesla and Nvidia, are highly manipulated and polished up. And if we could look at the inside books and track the fund flows at their bank accounts and look at their invoices and their receipts, et cetera, it would show a different picture. And insiders know the economy's not as strong as is being purported, or as the Fed and the government are trying to sell to us. And that's why they're selling. And I mean, if I was an insider, I'd be unloading everything I had. I wouldn't even hold shares in a company. I mean, the only shares I hold, other than my short positions, are mining stocks.
So, okay, I'll have a question on that here in a moment. Staying on the markets for a second, I'm sure you've heard of these folks. The Hawk Tuah girl, she launched a meme coin. Yeah. Everybody lost their money. Millions evaporated overnight. Some guy bought a banana taped to a board. I'm sure you saw that for $6 million. And then he ate the banana. And then there's a new meme coin called Fart Coin that now has a market cap of $1 billion. It's bigger than about 40% of the companies in the S&P 500. What in the world is going on here? And doesn't this type of ridiculous speculation end very badly?
Oh, absolutely. That's why part of the reason why I say what's happening in terms of the asset bubble going on now, it's much worse than what we saw in 1999. And what you just described is evidence of just how out of control this bubble is. I just read an article yesterday, and all of a sudden SPACs are coming back. And I didn't know the number was this great, but it said that, SPACs lost 99% of their value before investors stopped buying them. And just to kind of circle back to your insider selling question, because when I saw that, the first thing I asked myself is, well, who's buying the other side of that? Because if it was just selling, it would drive the market down. And as it turns out, households have a record percentage of their financial assets in U.S. stocks. And so you're basically seeing the classic cycle where you get a runaway stock market, insiders sell and dump their shares onto the public. And there's also, probably hedge funds. We know that hedge funds and the CTAs have piled into the stock market, and so they're buying some of the shares that the insiders are selling. But I would say the bulk of those shares are going into the general stock ETFs that the public invests in, the retail investor.
So are they going to end up being bag holders in a significant downturn?
Don't they always end up being bag holders? I mean, so I've been working professionally long enough to have been through the '87 crash. And then we had some bumpy stock markets in the early and mid 1990s. Well, the market crashed again in 1989 when I think it was the United LBO fell apart or something, and Drexel went bankrupt. And then we had the dot-com bubble, and then we had the 2008. That was a stock bubble, but it was overshadowed by the credit market and housing bubble. 2020, we would have crashed in 2020. I mean, we crashed, but it was like a 4-week crash that the Fed saved by starting to print money again. And I think we would have seen something that was worse than the dot-com bubble crash develop that year if the Fed didn't have an excuse to start printing, the 4 trillion that it printed. And then now, I mean, for me, like watching the stock market, it's like watching a train wreck in slow motion. I just can't tell you when the rug is going to be pulled out. Like I said, I think Wednesday was a warning sign.
So, Dave, as markets have gone to literal nosebleed territory, evidenced by NVIDIA's rise from 1.18 trillion market cap at the beginning of the year to now greater than 3.5 trillion market cap, the focus really should be on what is egregiously underrepresented in the indexes, and that stands to benefit when the tides turn and the markets rebalance and revert to the mean. What do you see as the most egregiously underrepresented sector or sectors right now that would greatly appreciate when this tide turning happens?
I mean, I think the initial leg down's not going to spare any sector. I mean, because what we saw in 2008, the stock market actually started tipping over. Again, I'm just relating the chart from memory. I believe like August or October 2007, and then we had a huge, a pretty big down leg in September and October that year, and that took everything down with it. And then what happened was the Fed started making noises about printing money, Ben's helicopter money, and the mining stock sector, the precious metal sector, reversed and started going higher, while the rest of the stock market kept going lower until March of 2009. So again, people might say I'm biased, but I honestly, other than the precious metal stocks, the mining stocks, and maybe some other natural resource and commodity based stocks, I think everything's overvalued.
So do you feel comfortable if the stock market tips over and has a significant down leg like it did the previous times you've referenced, do you feel comfortable holding mining stocks through that initial down leg, being positioned for when it does reverse?
Well, I did in 2008, and it worked out pretty well. But I'm actually leaving more cash on the sidelines than I did that time, so that I can scoop up share the mining stocks if in fact that's the way it unfolds. I mean, just because it unfolded that way in 2008 doesn't mean that it will this time. Although I just think everything gets caught up in the downdraft when hedge funds and actually just regular, managed funds have to sell money because their investors are pulling their money out of it.
Do you see this downdraft happening fairly soon into the new administration as a way of it being an excuse for the new administration to basically pin the tail on the donkey of the old one, or vice versa?
I don't know. That allegation's been tossed out there that, the Democrats are going to let the stock market crash right after Trump take. I don't think that's the impetus that's going to drive the stock market. I mean, there is some truth to that adage, they don't ring a bell at the top. And it's just kind of one of those things where there's some inertia that all of a sudden buyers stop buying and sellers only want to sell, and they don't care. It's like, again, that the old adage of yelling fire in a crowded theater and there's only one exit door. And that's the dynamic that causes markets to crash. Now there's almost no fear in the market, even though the VIX did what it did on Wednesday. It's already down 9 points from where it topped out on Wednesday. And so again, it's reflective of the fact that investors still think the stock market's bulletproof. But if you look at I'm sure you look at these or are aware of them anyway. There's a lot of internal indicators with the stock market that are signaling that something bad's going to happen at some point in 2025. And, again, the indicators don't, for instance, breadth. I mean, the media has been, pretty widely disseminating the fact that up until, well, it'll be actually, I think, up until today, because the stock, and it might even be today, even though the stock market's up quite a bit. I mean, we had 14 days in a row of negative breadth in the in the stock market, and that was by far a record. Number of consecutive days of breadth, and also the Dow declined. I believe I'd have to go back and count the candlesticks. I think it was up until again today,
11 straight,
or yesterday. I think it was slightly green yesterday. I think it was 12 days in a row the Dow fell, and that's never happened in history. And that's an indicator. That's a signal. So I've been writing about those indicators for the last 3 weeks in my short sellers journal. So and there's a bunch of them.
Do you think that based on these indicators that you referenced, and there's others, that is maybe the reason for basically the biggest coordinated easing by central banks? There's been 66 rate cuts and counting in the last 3 months. It's the biggest since the 2008 great financial crisis, but yet the macro conditions don't look anything like that time frame. Do you think that these indicators under the hood are the reason for these easing, or is something else going on?
I mean, in my opinion, I don't think that the Fed is easing up on its monetary policy, and the same is probably true with the ECB and the Bank of England, and to some extent, a big extent actually, by China. I think that the big bank balance sheets are growing ever increasingly distressed, because if you look at especially with subprime, there's obviously the commercial real estate thing which got swept under the rug, but that's going to start coming to a head again in 2025, because that's when the big wall of maturities start to happen. And it was back in the spring of 2023 when the regional banks blew up because of CRE. It was misrepresented that the big banks don't have exposure to CRE, and that's BS. Yeah, and it's not just CRE. I mean, you've got you had that whole cycle of leveraged lending, right, to the private equity sector, and most of the banks that were involved in that toward the end, when it dried up, they weren't able to syndicate the leveraged loans they were underwriting for those companies, and they hold those on their balance sheet, and those are increasingly becoming distressed. You've got consumer debt.
And what about the bonds? The bonds that they bought during that time frame of the pandemic. The 0%, the quarter 1% bonds that they're holding on.
Oh, yeah. Well, that's affecting it also. I mean, it's not just the regional banks that have their treasury bond portfolios underwater. So do the big banks, and so there's that. And you've got consumer debt is becoming increasingly distressed. At some point, and it's the
speaking to that,
the delinquency and default rate on household mortgages is starting to rise, and that's going to get worse, especially as unemployment gets worse. So, and also recall that during the pandemic, they issued a moratorium that if you couldn't make your auto loan or your credit card payment, you didn't have to make it. Well, those moratoriums were lifted, I believe, about a year ago, and that's
To your point on all of this, also, there's something like 60% of the student loan cohort that is going to have to restart making payments this January, because for the first time since prior to the pandemic, any delinquent notifications going to the credit bureaus are going to restart this January.
That's right. That's correct. I'm not sure that's as much. I don't think that's much of an issue for the big banks. But it's an issue
for the consumer.
Yeah. Well, and it's also, the government guarantees those loans, right? So, someone's going to have to pay for it when they default. But circling back to, the easement in monetary policy that's been going on globally, I mean, I truly believe that it's directed at easing the rate of distress on the big bank balance sheets. And then secondarily, well, I don't know what goes on over in England or the EU or China, but certainly by lowering rates, the Fed's trying to make it less expensive for the Fed to for the government to issue debt.
That's a huge one.
And you know, at some point, like I said, I think we're going to see QE come back, and a part of that reason is to finance the government debt issuance.
So is the impetus for QE a major stock market drop, or what do you see as the cover story as them saying, okay, it's time for the helicopters to start flying?
Well, I think what they're going to have to do is they're going to have to try and trigger a stock market issue so that they can turn around and have a reason to print money. I mean, that's what happened in 2008, right? As soon as the stock market crashed and the big banks were blowing up, the Fed decided it was time to start printing money, and the same thing in 2020.
Okay.
So,
all right,
I to answer your question, you know, what will happen when they eventually announce, and I don't know that they're going to refer to it as QE. That, you know, they'll find some Orwellian term for it and try and fool people. But yeah, I mean, if they're going to pump liquidity into the banking system again, that probably saves the stock market. And, you know, especially in that scenario, the precious metal stocks will really do well.
So let's shift over to gold here. Gold prices, they're coming back nicely after the post-FOMC rate cut announcement sell-off. The gold and bull market just continues to exhibit strength and the ability to shake out the weak hands on any pullbacks, which seem to be fairly short in duration compared to previous timeframes. Now, with that, gold is only representing about 0.5% of global financial assets currently. And over the last 4 to 5 decades, it has a mean of about 2 to 3%. Are you expecting a reversion to the mean in the coming years? And if so, what would that translate into for the price of gold and gold-related equities?
It's a good question. One thing, just as an aside, I mean, when we're referring to the sell-off in the price of gold, most of that price decline occurs when the big Eastern Hemisphere buyers have closed shop for the night, and it leaves just the London and New York markets open, and most of the decline has occurred only when the COMEX is open, and those are I mean, yeah, there is physical gold traded in London, and you know, but it's also a gold derivatives market. That's what a gold forward is a derivative, and the COMEX, I mean, very little gold ever leaves the COMEX. So I don't even look at the COMEX as a gold trading market. It's a paper gold trading market. And that's been the primary factor in the price decline is the bombardment and selling of paper contracts on the COMEX. Now, the Asians and the Indians love it because when gold ran up to 2,800, they pulled their horns in and stopped buying physical gold. And if you look at I watch a 15-minute chart all day long, and if you look over the last week, the price has actually been rising during the hours when India and Asia are open, and then Asia closes. I think China closes at like 3 a.m. our time, or 3 a.m. New York time, and that's usually when the price of gold starts heading south again, because then you're really the only major markets that are open are London and New York. Well, the COMEX isn't open, but the electronic system that is used to trade COMEX contracts that runs 23 hours a day. So, I don't, you know, it's not like the entities that have been huge buyers of gold for the last couple of years, the Eastern Hemisphere central banks and such. It's not like they're out there dumping their gold and that's what's causing the price to go down. Exactly. They're actually, I mean, China's been buying gold this whole time, even though the news has been out there that they stopped buying, I think, in May. Well, that's BS. And there's a guy who puts out research that can prove that. But I think what's most different about the move higher in the sector that we've seen this time around is that is just the enormous amount of physical gold buying by Eastern Hemisphere central banks and their populations. I mean, the Chinese and the Indian populations, they're huge buyers of gold. The Vietnamese are big buyers of gold. Turkey's been a big buyer of gold. Their population buys gold. So, and that to me is what's been putting the upward pressure on the price.
Okay.
And I guess to get back to your question about, the 0.5% of 1%, I don't know. So again, now that there's vehicles like GLD, institutions, for the most part, if they're going to buy gold, they buy GLD or one of the other ETFs. And again, those to me, and I've done the work on it and the research, those really are not bona fide gold investments. So, and there's no way to know, how much gold is really sitting in the vaults. It's not coincidental that JP Morgan and HSBC are the custodians of those vaults. JP Morgan was recently added as a co-custodian of GLD. It's always been the custodian of SLV. So, and again, part of the reason why those ETFs came into existence. I mean, of course, they make money for Wall Street, and they make money for the trustees that operate those ETFs, was to divert money away from going into physical gold and into these derivatives of gold. And that was the reason why COMEX gold contracts were actually introduced. They didn't exist until 1974. But, I'm assuming you're familiar with GATA, GATA.org. Well, if you go on there, if you go and look through their archive, I think it goes back to like 2000. There's an article in there, because I read it when they published it a long time ago. There's an article in there that has like communications between Henry Kissinger and his financial advisors that specifically talk about what they were going to do because we went off the gold standard. The price of gold started going crazy because it was freely trading. It wasn't fixed at $35 an ounce. And they specifically referenced, what are we going to do to prevent institutions from buying physical gold? And that's how they decided to come up with, introduce gold futures, which were, again, like I said, were introduced in '74. I think silver futures have been around since the early '60s. So, and to me, that's what GLD and SLV are. They're diversions to divert money away from actually going into physical gold. I don't know that we need Western Hemisphere investors to keep the price of gold pushing higher. I don't think the Eastern Hemisphere is by any means done buying what they're going to buy.
Yeah, and that's what the metrics and data are showing. So you were talking earlier, Dave, about the M2 money supply and the correlation to gold. What are you expecting for the M2 money supply and the gold price moving forward? Do you expect it to stay highly correlated, and are you expecting a massive uptick in the M2?
Here's an even more interesting correlation. Yeah, it's correlated with M2, but there's a real strong correlation between the rate of change in Treasury debt outstanding and the price of gold. And you can even throw inflation in there. And if you go to the St. Louis Fed database or website, you can pull those numbers up. They actually, I think they stopped. I don't even think the Fed publishes the price of gold anymore on its website. I think they stopped publishing the data for that. But you can, you go back and you can see, like in 1971, all of a sudden, the amount of government debt outstanding starts to take off, like a plane taking off from a runway, and then it turns into a rocket ship and starts to go straight up. So I would argue that, well, and again, I guess in my opinion, the way I look at it, debt behaves like money until the debt has to be repaid, right? Because the debt instrument, you issue an IOU, you take in that money that's already in the system, and then you spend it again, right? So debt issuance behaves like money until you have to repay it back. When was the last time the government repaid back its government debt? Never. They like to argue that the deficit or the amount of debt decreased slightly in I think 98 or something. But it was Robert Rubin's accounting sleight of hand that caused that. So again, and that's why the Treasury debt issuance, and that's an issue that we didn't talk about when we were talking about the problem with inflation, is that Treasury debt issuance is every bit as inflationary as printing money. So and it looks like. I mean, it's already started to go parabolic, the amount of Treasury debt outstanding, but it's going to get worse in 2025. I mean, the spending deficit in the first 2 months of the government's fiscal year, October and November, was by far an all-time high. And then if Trump gets in there, I don't know that he's going to be able to cut taxes, but that's going to make the problem even worse.
Yeah, this is going to shape up to be an interesting year for sure with the deficit issue, with the how the deficit is financed, the budget. If Doge can be successful, how Congress is going to fight that. It's going to be extremely interesting. But Dave, I want to ask you about gold mining stocks. They've been collapsing. Newmont and Barrick Gold, the two largest gold mining companies in the world, they're both down big. Newmont is more than 10% lower today than it was when spot gold was trading at $1,750 in 2022. Spot's up almost $1,000 an ounce, and Newmont is down 10%, despite having its best year in decades. Really, the entire sector is in the sale bin. Why do you suppose this is?
And just lack. Well, I think there's two factors there. I think a lot of. I was looking for a chart that I have that shows GLD or GDX versus. Here we go. The Amex Gold. Well, it's the ARCA Gold Bugs Index now versus the S&P. I think so. If you look at those charts, it shows that mining stocks, other than back in 2001, mining stocks are as cheap relative to the stock market and as cheap relative to the price of gold as they have been since the secular bull market started in 2001. I think part of it is you've got the audience that invests in gold stocks has been burned, a handful of times particularly in, starting in 2012 to 2016. They were burned by holding the mining stocks. And so I think there's some reluctance on the part of the retail and high net worth guys to buy the stocks, because that's a large segment of the investor money that goes into the mining stocks. The institutions, I mean, when they buy mining stocks, they primarily just buy Barrick and Newmont. And the institutions, I mean, if they're not getting money in from investors to invest in the mining stocks, they're not going to be buying mining stocks, right? And so I just think until the tech bubble or this asset bubble pops, particularly the NASDAQ, I think that's where all the investor interest is focused. So, and when that
basically
changes,
is casting a big shadow over.
Yeah, exactly. When that changes, then I think that's when our sector really takes off. And I think it will transition in 2025. One of the narratives that went around when the inflation really started ticking up again was that it was going to just annihilate mining stock profitability. And it did for a couple quarters, right? You had their cost of energy went through the roof when oil went over 100. And that's the cost of energy is 50% of the cost of mining. But that's changed now because energy prices have come down. Most of these companies, I can't speak to Barrick and Newmont, but I can speak to companies like Fortuna Mining. They creatively found ways to cut costs. Like at their Lindero mine, they figured out a way to cut the amount of cyanide that they use in the extraction process by something like 50%. And cyanide is expensive. So most of these mining companies have adjusted their cost structures to the higher cost of mining. And I mean, the profit, as you pointed out, the profitability, and it's not just Newmont and Barrick, the profitability of some of the lesser known producers is just off the charts right now. And because right now the spread between the price of gold and the cost per ounce to produce it is pretty wide. It's like they call it in the industry, they call it, we're in the sweet spot right now. And, if I'm right in my view that gold is going to continue pushing higher for, because of, the money printing that's coming, all the variables that go into pushing the price of gold higher, and the physical accumulation in the Eastern Hemisphere continues, then that spread between mining companies' costs and what they sell the price of gold for, and silver, is going to continue to grow. It's going to continue to widen.
Yeah. They're literally printing cash right now.
Oh, it's unbelievable.
Well, it is. So, well, this has been a fantastic conversation. Before we wrap up here, and I ask Dave our final question, I want to point everyone over to our Substack. Go to metals&miners.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metals&miners.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Dave as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, it's now time for the Golden Nugget segment. Dave, let's discuss something that I've been asking all of my guests lately here as we wrap up 2024. It's a future scenario. Picture two tables, Christmas party 2029. One table's really happy, one table's really sad, and they are the way they are because of what they purchased at the end of 2024 going into 2025. Okay? What do those two tables, the happy table and the sad table, in 2029 represent in terms of asset classes to you?
Ooh. The unhappy table is overweight in stocks and bonds, financial assets. The happy table is the table that instead of, they took their money out of the stock market, they realized what good fortune Fed easy monetary policy has given them, and the stock bubble has given them, and they've converted a large portion of those proceeds into physical gold and silver that they safekeep on their own.
Interesting. So what about the mining stocks? Neither table has mining stocks?
I would just assume that if you're buying physical gold and silver, you're also making a leverage play on gold and silver by buying the mining stocks.
Okay. So those who have precious metals as a large percentage of their portfolio in 2029 are going to be happy, and those who are still holding financialized assets, whether that be portions of the NASDAQ or its treasuries or whatever, those folks are not going to be as happy.
Correct. I think that the happy table, they'll also be happy if they buy some commodities based ETFs. And I know for myself, my allocation is roughly 70% to physical metal and 30% to the mining stocks. I'm probably going to tweak my percentage in the mining stocks higher as we move into 2025. But again, I'm leery about, I'd like to see, when the stock market crashes first, because I want to have cash to just go in and buy the mining stocks hand over fist.
Makes sense. Dave, thank you so much for coming on to Metals and Miners, for being so generous with your time and your analysis and your ideas. It's been awesome to spend the time with you. Would you summarize your views that you've covered today and then let those know who are tuning in where they could learn more about your work and how they can connect with you?
Sure. I think that we've spent 4 years, and I'm not gonna, just blame it just on the Biden administration. Trump was guilty of it during his term, and he'll be guilty of it again going forward. Let's just say we've spent the last 4 years of the government and policymakers, and the Fed of misrepresenting just how strong the economy is. The stock market has never been as dislocated from fundamental realities as it is now. Inflation's running higher than it is. Based on the data that I study every week, I'd say roughly 70% of all households is feeling some degree of financial distress. And many of them are living, paycheck to paycheck. I read an article that said, there's going to be a huge percentage of households that use those buy now, pay later loans to fund their holiday spending. So, in summary, I think the economy is worse than is being represented, and especially, when broadcast in the mainstream media. And I think inflation is running much higher than is being represented. And I think the stock market is just an accident waiting to happen, and it's going to be a bad one. And, the Fed probably tries to address it, but it's not going to be able to, the initial thrust is not going to be able to do anything about.
Okay. I appreciate all that. And how do folks get in touch with you and learn more about your work?
Sure. My blog website is investmentresearchdynamics.com, and I have links to both of my newsletters right at the top that explain what they are and what they cost. And then I also recently started a Substack. It's just called, the Mining Stock Journal Substack. So you can also get a hold of me on there.
Wonderful. I'm going to put all that information up on the screen. I'll also have it in the description area for everyone. They can click through those links and get over to your stuff and check you out. I've been following you for a couple of years, Dave. I really appreciate your viewpoints, the work that you're putting out there for the community. I think everybody who's listening needs to go follow you. Thanks for being here. I look forward to having you back on. And everybody else, thank you for watching.
Thank you, Gary.
Point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.